Do you want to maximize your success with NCUA? Join Mark Treichel as he shares with you the insider's view on passing your exam with flying colors. The With Flying Colors podcast is sponsored by Credit Union Exam Solutions by Mark Treichel. If you would like to work directly with the Credit Union Exam Solutions team and receive support to optimize your results with NCUA so you save time and money, visit us at marktreichel.com to find out more.
Hey everyone, this is Mark Treichel with another episode of With Flying Colors. I'm back with two frequent guests, two of my team members, Steve Farrar and Todd Millard. Guys, how you doing today?
Doing good. Very well.
Very well. All right, and we're gonna chat today about what we're seeing, what we're hearing in the landscape of our credit union conversations with our clients, with just general conversations we're having with credit unions. Transitioning over the last couple of years, what NCUA is doing as it relates to exams right now. But before we jump into that, the folks that listen to every podcast know who Steve and Todd are, but we may have some new listeners today. Steve, why don't you give a little bit of your background in the credit union world and at NCUA?
All right, sounds good. My career over 30 years in NCUA can really be broken into two parts. The first half of it was spent in the field in the examiner ranks. Most of it as a problem case officer, working on those troubled credit unions, mainly on the West Coast, but I ended up being involved in conservatorships throughout the nation. Then I ended up in the central office about the time Mark went into the central office, and I worked remotely in the Division of Risk Management. And that was a great job because I got to be involved in lots of issues throughout my career. Some of the more interesting ones is I ended up writing the enforcement manual and was involved in the corporate resolution. And then the last part of the career, I worked mainly on the risk-based capital regulation.
Very good. Very good. And Todd, a little summary of your 34 plus years at NCUA.
I spent 34 years. I would break my career into three parts instead of two parts. I spent about a decade or a little bit more as an examiner and a problem case officer. Then I spent a decade or so as a capital market specialist, a regional capital market specialist. Then I spent the last 11 years of my career as a director of special actions in the Western region, supervising problem case officers and capital market specialists. And that tenure started right during that last recession. So it was a pretty busy time as a director of special actions during that last recession.
Boy, isn't that the truth? So two funny stories that just popped into my head before we start off. Steve, you mentioned that you came into the central office about the time I did, and there's a correlation there because when I was and if for those NCUA folks listening, here's a little bit of NCUA history you may not be aware of. The agency did not have remote staff other than their examiners. If you worked in the office, you had to be in the office. If you worked in the Office of Examination of Insurance, you needed to be in the office. And up until that point in time, leadership had not wanted to do that. And then E&I director Dave Markey was having trouble getting his positions filled and getting good applicants. And I said, why don't you offer a remote position? You might get someone like Steve Farrar to apply, because Steve and I had worked together in the West Coast. And Dave looked at me, he goes, can I do that? And I said, sure, why not? So we announced it. The announcement came out, and Jane Walters comes running up from the fourth floor, says, what's this? You're letting E&I take remote staff? This doesn't make sense. And I said, well, Jane, I think they need to have a broader pool, and I think they can do these jobs from the field and don't necessarily have to be there. And we need our best and brightest to be willing to take raises. And if you got really smart people sitting in Montana that are never going to be in Montana, the agency can be better if we offer these. I might not have given that example, but that was what was in my head. But I did suggest to Dave that Steve might have applied. Lo and behold, Steve did apply. He ended up getting the position, and then later actually ended up moving to the East Coast. And so that's the history of the remote analyst, the remote anything at NCUA goes back to that conversation between Dave Markey and I. And of course, they might have gone there at some other point in time, but we had then opened it up to the regions, and they ended up starting doing that, which created better career paths. And then Steve and I, you talked about conservatorships and different things. You worked on the corporate crisis, and then I got thrust into the corporate crisis and needed to bring in people that that I trusted, and B, that were smart. And Todd, sometimes you'll refer to your lost year at Westcorp when I swore you to secrecy and brought you in to help us figure out next steps at Westcorp. So those are two additions to the journey that you two were on, and which bring back fond memories, but scar tissue. All right, guys. So it's been an interesting year so far in credit unions. It's been an interesting couple of years in the economy. And we're seeing, as I like to say, there's a rhythm to what we're seeing based on history and also based on where the trends and examinations are going. But let's speak a little bit to the conversations we're having, the things that we're seeing repeating out in credit union land as it relates to examinations. Anybody want to proffer up one thought first here?
Sure, I can go first. It's interesting. Each year, NCUA issues this supervisory priorities letter. And what we see are somewhat consistent with that. If you look at the last couple of years, back in 2022, 2023, when that yield curve inverted and you started seeing rates climb, those years, there was a heavy focus in our clients. Almost all of them were getting doors and findings on interest rate risk and liquidity risks. A lot of our clients were asked to reduce their interest rate risk back in 2022 and 2023. Loan concentration issues seem to have been an ever-present thing during the last 2 or 3 years. As we got into last year and this year, we have an emerging type of trend, and it's probably a positive one, where the examiners seem to have a very increased focus on board governance. And there's lots of pieces to that board governance one, but that's a big one that we're seeing here in the last year and a half or so, is this focus on board governance and our board members having appropriate oversight over their staff. And then the commercial lending has been a big thing last year and this year especially. And the other thing we're seeing, and this has been a constant during this whole time, is they're really focusing on weaknesses in commercial lending programs. We've even had a couple clients that have been told to cease commercial lending until they fix some of their internal controls and program monitoring. So that's a new one.
That one had fun, Todd, because just imagine though, if you're listening to this and then NCUA came in and your program that is probably your cash cow and has a number of staff in there and they tell you to cease that. Just think of how the impact of that has on you. And now you have the challenge of, if they're good people, retaining them while you're not producing new volume. So that is, it's a huge obstacle, but needed to be done in most of those cases because the risk had become just so great. But boy, that is almost a poison pill.
That word cease, I remember when I was executive director, credit union on the East Coast, that in the region I used to supervise, a really smart examiner actually used the word cease, right? And which is not a good word to use in the exam just because of the concept of cease and desist order, which is like this legal document that is rarely used, but it's used in banking. It's used at NCUA on very rare occasions. But discontinue, you'll see people use. But I think that one particular case that I am mentioning might have been what triggered. I know, Todd, in some of our conversations, you have mentioned that if you're going to tell someone they have to stop doing something, that the policy now at NCUA is that needs to be run up the flagpole to a higher level. Is there anything you can share relative to your memories on how that policy works? If someone's going to say stop commercial, what does that trigger at NCUA?
Ceasing anything at NCUA requires your supervisor's approval. An examiner doesn't get to make that choice themselves. And while it's not required, I suspect anytime a supervisor has got a recommendation from an examiner about ceasing a program, I'm pretty certain that supervisor is going to have a conversation with the ARD as well. It's going to be a couple levels above an examiner's head that it's going to sign off on a door or an action that says cease an activity, because there's just reputation risk involved in that. there has to be a certain high degree of risk to the insurance fund when you tell the credit union to cease something, because you are creating reputation risk for that credit union. Like Steve says, you risk people leaving if that is going to be a short-term thing. Generally, when NCUA asks you to cease a program, they have conditions in place before you get to restart that line of business again. And usually the problems are severe enough that you don't get to fix those, or you're not able to fix those in 2 or 3 months. It's usually an extended period of time to meet all the conditions you need to meet to restart that again. So they're pretty significant actions on the part of the agency.
We did have one situation where we were able to assist a credit union that had the word cease come forward in a draft document. But the things that Steve mentioned and Todd that you just mentioned, that if you shut a program off in totality, it's harder to turn it back on. And oh, by the way, what happens to your staffing, and will you be positioned to keep them or not? And in that particular instance, without going into details, we were able to, the credit union, and with discussions with us, we're able to get the NCUA to give a little bit more flexibility relative to that. Now, you can see them telling, or we've seen them say that they need to cease because of non-compliance, and we've seen them tell credit unions to cease because of concentration risks, or perhaps that they don't believe the concentration risk, the risk appetite, if you will, has been adequately defined by the credit union. So that particular topic, I've seen it coming from different directions. Any thoughts on, I don't think risk appetite is anything we've discussed here yet, but board governance, concentration, risk appetite. Any thoughts on what we've seen or what you're hearing on the risk appetite front? Because that's a subcategory of a theme of a lot of our discussions that I'm recalling from the last 2, 3, 4 months.
It's somewhat interesting, and the agency says credit unions outside of ones don't need enterprise risk management type programs. But more and more, if you actually read the doors that people are getting, the board governance issues they're getting specific to concentration risk, and we've been seeing this for the last 3 years, they want credit unions to justify their risk appetite and those concentration risk limits. They want actual modeling support that those limits are appropriate. And those are all directions that they're really moving every institution out there towards having a reasonable capital plan, a reasonable risk appetite state. So they're getting everyone 80% to an enterprise risk management program. That seems the direction that they're pushing. I think some of this board governance is a subset of that too. They want the boards to know exactly what their risk appetite is in their credit unions. They want to know what the credit union's risk position is. And there's a greater expectation, or at least they're putting down on paper a greater expectation for boards to supervise and hold management accountable for these risk positions. And that's not a bad thing. It's probably a good thing.
The hold management accountable in corporate governance. I've said this, I don't know if I've said this on the podcast, but I've said this in some conversations with clients. It almost seems as if when the examiners see something that happened they didn't like, whether there was zero board governance or 80% of what NCUA wanted to see in board governance, they raise it as a board governance issue. It's, here's a program that went awry, or here's a program we're questioning, or here's a program that doesn't have enough safeguards around it. It's almost as if NCUA staff have had advanced training on board governance when they got down together in New Orleans last year. But it's definitely a theme that's running through that. If there's a door that's tied to A, B, or C, it may also be linked to board governance.
We see that word appropriate oversight quite often. We see them holding board governance accountable for a higher level of accountability for strategic planning. Profitability issues are under that umbrella of board governance that we've seen. A very big one that we're seeing is they expect board members to have a band of due diligence on new programs. New programs have come up multiple times in the last year where there's an expectation the board is fully aware of the risks and rewards of new programs, throwing that under the board governance issue.
Even going so far as possible new programs. I've seen credit unions get dinged where they're just contemplating, we might be thinking about having a discussion. Why wasn't the fact that you might be thinking about possibly having a discussion in your board minutes, which in that particular instance was a little bit farther than I think reality would have been appropriate in, but it's definitely focus that they're having. And one other thing that popped into my head, and this is some research I need to do, there is no broad requirement for enterprise risk management. The ones credit unions is where that all started. And there is an expectation at ones that they are going to have enterprise risk management. Corporate credit unions by regulation are required to have enterprise risk management. Somewhere along the line, and I'm not really certain when, there is a portion of NCUA's examiner's guide that says enterprise risk management guidelines for large credit unions, but it does not define what large credit unions are. And as I'm thinking through that, we've talked a little bit about the Chevron case. The way the examiner guide works now, it's like a living, breathing document. They go in there, they make a change to something. It's not announced to the world. It might be redacted so the world really doesn't know what it says. But there's this new section, whether it's 6 months, 12 months, 18 months. I'm guessing it's more around a 6-month timeline on enterprise risk management. It's going to be interesting to see how that trickles down. I think the challenge ultimately that they have is if they come out with a letter to credit unions on enterprise risk management, that could lead to people pushing back. That could lead to what's this board member want in it? What does that board member want in it? And so there's a subtler way for NCUA to effect change, and that's by dropping it into the examiner finding or dropping it into the National Supervision Policy Manual, which is also heavily redacted. So it makes it challenging for credit unions to understand the expectations. It makes it challenging because of the challenge of safety and soundness being a broad brush that NCUA paints with frequently. Steve, you and I had talked a little bit about the challenges of the new world that might become because of Chevron. Anything I've said there trigger anything in your head?
Let's just cover the topic of what we see a lot of it. It's just frustration. And that the frustration is usually directly associated with their communications with their examiner, which is, I'm telling you, that's been going on since the Babylonians crossed the Euphrates, right? But we dealt with it the whole time. But what's happening now is you do have examiners getting back into the credit unions and looking at things a little bit more. And they don't really have frustration with what problems they're finding that the credit union has. That's usually not the issue. They usually can be in agreement with, here's what our problems are. Sometimes the frustration is in exactly how it's going to be fixed and the cost of which that's going to be and the timeframes for that. But it really comes down to the main thing is that how you're communicating with that examiner can have a lot to do with how you see your regulatory process working for or against you. We understand it's different between the different generations and how they want to go about communicating, but it is an item we hear about a lot. So we tell the credit unions, do what you need to do on your end of the communications. And when you have a communication with your examiner, whoever, follow up with that email that says, here's what we discussed, here's my understanding of it. But to try and reduce that frustration level, I know you guys will have more thoughts on that.
That's a great conversation that I think we should have. I got a couple of thoughts, but Todd, I'm going to let you chime in first.
The communication part has always been an issue. And I think some of it today, they missed a lot of things during COVID years. And we're seeing that with some of our clients that they're bringing issues to light that have actually existed for a couple of years and were not brought up before. Like Steve says, that creates a little bit of frustration. NCUA's policy and practices have always been when you have issues that the credit union needs to address, they're supposed to sit down with management and have a conversation. How do we best address these? There should be some give and take. There should be some give and take on timelines to correct things. And more, what we're seeing is exam reports are taking a long time from the time they finish field work till they get to the credit union. And then the credit union gets surprised, that they get a door and they're given 60 days or 90 days to fix it. And it's a total surprise that they haven't had this discussion about this issue with their examiners during the exam. I think some of that is maybe resource constraints on the part of NCUA. They're a little bit behind. Maybe some of it's just, they got into bad communication habits during COVID and aren't used to sitting down and talking to management. Some of this is on credit unions. We have one client where none of their management teams are on site, even though the credit union examiners came on site. So there's both sides to the communication breakdowns. Credit unions, you're responsible for your members. So if your examiner's not doing their part, I guess you have to step up your game and do your part a little bit more. But communications is a big piece of this, and surprises don't go over well. And some of our credit unions just seem to be surprised more and more that they get a report and there hasn't been a full discussion of these doors in them.
I wrote, after Steve brought this topic up, I wrote down resources and no surprises or surprises. And there really shouldn't be surprises. Back in the day, you had to give them the draft report when the examiners were allowed to give Camel and the full report a week before any meeting. And today just last week, there were credit unions finding out at the joint conference what the code was, not having seen any documents other than draft doors that were delivered 2 months earlier, and the timelines had already passed. And it's a little bit almost like trying to get, sadly, I think there's a little bit at the agency of trying to get toothpaste back in the tube. They're having difficulty getting their work done timely. They've brought it up at their board meetings that only 80% of code 3s were done within policy. Only 67% of code 3s were done within policies. Only 80% of code 4s were done within policy. Meanwhile, Camel codes are getting worse, meaning they're having to do more follow-up exams at the credit unions they have, while half their staff has come on or more of their staff has come on since the Great Recession and hasn't seen the churning of the challenges of what Camel codes can do to their resources. And, oh, by the way, what it can do to credit union resources when NCUA comes back every 6 months instead of every 12 months or 18 months if you're on an extended cycle. So, yeah, the communication, it goes back to the beginning of time, and it's wreaking havoc in some situations. And so the best advice for credit unions is what Steve said there, that to document what your agreements are, encourages taping of exit conferences, which when they first came out with that approach, I really didn't think was necessary. But the more time goes on, I think that's a pretty wise step in the electronic world we're living in here today. Todd, you brought up previously the heavy focus on interest rate risk and liquidity risk. That seems to be trending down in 2024. We've talked about board governance. Steve, I know you have mentioned on the topic of board governance, we're seeing it a lot, but there's a document that you like to refer clients to a lot. Do you remind me what that is?
Yeah, it's something I carry with me almost everywhere I go anymore. So it was put out by the FDIC, and the title of it is Guidelines Establishing Standards for Corporate Governance and Risk Management for Covered Institutions with Total Consolidated Assets of $10 billion or more. And this was put in the Federal Register in October of 23. We do find there's this trickling down. It's really good guidance, and I've shared it with some people I know that are on boards of large credit unions, and they're like, wow, we're not subject to that because they're usually below 10 billion. But the guidance, they find it to be really helpful and is a good tool towards training their board members, and just as a requirement to have them read through it, because it has a wonderful definition of risk appetite and the training of the board and the responsibilities of first, second, third line. It is something that we have been sharing with anybody that is starting to get that corporate governance question.
Yeah, that's a really good document. And like you said, you might not be a $10 billion credit union, but whatever size credit union you are, you can learn good basic principles by reading that document. And you might glean, if you're a small credit union, you might glean 2 or 3 things that you might want to add. If you're less than 10 billion, you could probably bulletproof your board governance if you took a lot of those principles into play. And of course, there's cost associated with it. But some of it's just common sense on things you need to think about, like having an ethics linked to it, et cetera, et cetera.
I think you can even circle back a little bit more and understand why NCUA is doing this. If you look at all their letters, if you look at the regulation, they use this word with risk management systems commensurate with your size and complexity. And the fact of the matter is as credit unions even cross that $1 billion threshold and you start having complexity where you got commercial lending programs, you got third-party lending programs, you've got direct real estate lending programs, you're selling things on the market, you have a high level of interest rate risk, even though your asset size might be a long ways away from 10 billion, your complexity is approaching that level. And realistically, to stay competitive and operate your institution in a safe and sound manner, your risk management processes have to evolve to almost where they're at that point. I tend to call it like a ruler of sophistication. And even when I was a director of special actions and I'd get $1 billion code 4, we would actually put in our door that they needed to get an enterprise risk management system in place before they got out of special actions. Because the reality is once you get a code 4 and you get it fixed, you want it fixed to the point where it's never going to come back to that again. You don't want to see problems repeated. And having good risk management systems in place, it prevents those problems from being repeated down the road again.
That reminds me of a conversation. Again, the conversations bleed together the longer we do this, whether it was on a different podcast or with a client, where you made the point of when you went into capital markets, how the agency was behind the curve on banks and credit unions were behind the curve. And now that's more of a mature understanding at NCUA and at credit unions, albeit it's been challenged over the last couple of years with things going on. And the correlation to that's where corporate governance is at, right? NCUA doesn't require enterprise risk management. They probably should, at least at some level. But the way they're bootstrapping that is by raising the bar in corporate governance, which in general is a good thing. We might see it on steroids sometimes when it doesn't need to be on steroids, but it's a good discipline for everybody to be aware of and to wherever they're at on it to improve is a good thing.
Along those lines, another topic we want to bring up is that I think we've seen issues where there was more requirements for different types of stress testing. And Todd, I'm sure that you might have kind of thoughts on that because there's a cost and benefit associated with those. And if you agree, that's something that we've been seeing a little bit more of.
We've seen this actually, we've been seeing it for the last 3 years. It is on the concentration risk and it reflects actually back to any policy limit you set, whether it's liquidity limits, whether it's interest rate risk limits, whether it's loan concentrations, borrowing levels. There's an increasing, it's not an increasing, it's been there for the last 3 years. There's an expectation from examiners now that credit unions can analytically support those limits. Along the ruler of sophistication, you use experience. Hey, this is where we set the limit. We think this is appropriate. While that was appropriate in the past, it doesn't seem to be sufficient for examiners today. They want stress testing for these limits. In some cases, simpler, less expensive ways to do that stress testing. At other times, some of the stress testing gets very costly and expensive. It's very sophisticated. We've seen credit unions where examiners on their documents resolution, they want commercial loan portfolios stress tested at an individual loan level. So the expectations for some of that stress testing and supporting of concentration limits is getting very high, and it's been there for the last 3 years. We see it almost all the time. And it used to be you looked at these limits per net worth and it was the examiner's judgment. This examiner, he's comfortable with 400% net worth in first mortgage loans. And then, examiner B comes in and this young lady is not comfortable with 400. And then someone like Steve or I come in, we're comfortable with 500. There's different informal risk levels that examiners set based on their own experience. Anymore, they're moving away from that and they're not leaving it up to examiner judgments. We're just seeing doors and findings that credit union, you need to support your risk limits in some analytical way, shape, or fashion. And Like I said, sometimes it's easier to do. Sometimes it's extremely expensive process for credit unions to go through. And it almost leads back to, and credit unions don't, or examiners don't articulate it this way, but it really leads back to just about every credit union needs to have a capital plan nowadays. And right now that's only expected of ones. But you mentioned it earlier, Mark, some of these expectations on one's credit unions seem to be filtering down to credit unions that are even under $1 billion in some cases when it comes to stress testing concentration limits.
And that becomes a challenge. I know the board packages. So if you have board governance, what does board governance need? You need to have a capital plan. You need to stress test this. You need to stress test that. And there's this danger of let's just add another layer of documents to what the board has to see, that the board has to sign off on beyond what the regulations say the board has to approve. And you become Lucille Ball trying to get the chocolates into the chocolate box, because there's only so many hours a day. There's only so many resources. And the smaller you get, the less of those resources you have. But an NCUA examiner sees something good in a $10 billion credit union, and then they do it in an $8 billion, and then they do it in a $6 billion. And the trickle down is real. It just happens. I knew it happened when I was at NCUA, but we see it all the time here. And it's a delicate balance between it all being wise and good to creating a burden that is just going to lead to unnecessary mergers, et cetera, et cetera. Any thoughts on where we're at on that pendulum, or any disagreements on how I frame that there?
I think it goes back to Steve's earlier words where this is one of the areas that creates frustrations for the credit unions, because the examiners will still support this analytically, do a stress test, but then the credit union will ask, okay, what does that mean and what is expected of us? And then the examiners can't really articulate what they want. We want a stress test. Okay, how do we go about that? And then it's dead silence from the examiners. And that builds in some of that frustration, in that they set expectations for this, but then they can't articulate what is sufficient for them, or how does the credit union go about it. So they leave the credit union hanging. We expect you to do this, but we're not going to tell you how or how much money it should cost or what will be acceptable to us. It's go through the process, and then we'll decide whether it's good or not on the back.
We'll tell you. Yeah, we'll tell you.
That builds in frustration, because Steve said these things cost money. You don't want to spend money and go through this with good intentions, and then your examiners tell you that's not good enough after you spent $50,000 and took a month. And I think this is one of the things that examiners, they don't necessarily dig into expenses and they're told not to dig into expenses unless there's problems. But I think for a lot of examiners, they don't really understand the costs involved with some of the things they put in their doors. Maybe your problem case officers or your more experienced long-term examiners do. Your younger examiners, and by and large, I'd say on average, most of your examiners have no idea what the cost is for those doors they're writing to the credit union. And sometimes, and you do see this, especially with newer examiners, the doors create more problems than they solve.
Yes, we've seen a handful of those instances as well, for sure. So what other trends are we seeing? Any other thoughts on what's going on?
I think the only one we haven't talked about yet is we're seeing a lot of that in one thing that we've seen in multiple clients, 3 or 4 of them. There's really this whole focus, and this is coming from the agency at the top, on consumer compliance. You got to make sure you get your Reg Z and truth in lending and all that stuff squared away if you're letting third-party people fill documents out for you. And this is one of those issues where it seems to bypass the COVID years where it didn't get looked at, and maybe some of it's just NCUA's renewed emphasis on this. But third-party relationships, you need to make sure all the documents of those third-party loans especially have all this truth in lending, consumer compliance issues, BSA issues all squared away, because NCUA seems to be digging into those types of issues with third-party lending relationships.
Yes, indeed they are. And that's going to continue, because let's see, the NCUA board has probably their agenda for July will come out today, I believe, because their board meeting's next week. And they'll either talk about where their budget's at or have a vote on the budget. But we used to do some reconfiguring at budgets like that. I'm guessing with this board, they might not. I'm not sure if Todd Harper's back. Chairman Todd Harper is back in the building and back at work for this board meeting. He may be. But there's the mid-year budget, and then coming up in November, there is the budget where Chairman Harper is going to have his first vote as a chairman with a Democrat who is also very pro-consumer compliance. As they have expanded into this area where they're watching Reg Z closer, where they're watching all these regulations as it relates to third-party originations, they're starting to see trends in certain things in that arena, which will fuel the fire for the NCUA board to perhaps say we need more specialists in this arena. And I know there's things going on at the agency where they're retooling some of that. I think there will be a big reveal at some juncture, probably at the budget briefing, where they'll come out and they'll say we want to add 20, and then they'll say that they listened, and they'll come in and they'll only add 10. They'll take out 10 of them and say they listened to the industry. But there's going to be more done in that. They're talking about doing separate compliance exams. They've alluded to that. There hasn't been a lot said about it, but there will be some sort of reveal relative to that, would be my guess. So yeah, that's going to be a growing area of review by NCUA for sure. All right, guys.
Information security.
It's what?
Information security is probably worth talking about too. It's always been an emphasis with NCUA. Credit unions have always actually been appreciative of what those regional information specialists provide on exams. In the past, their work has mainly been put out as supplementary facts or exam findings. We rarely see doors on information security. Of course, we have a big information security event going on right now. I think credit unions can maybe expect increased scrutiny in that area. They've been feeling it for years, but it wouldn't surprise me if things that were supplementary facts and findings in the past don't find their ways to doors, given what's happened in the last week.
Yeah, without naming names, everybody's going to know probably what we're speaking to, but there have been discussions and chatter that I've seen that this incident may lead to NCUA continuing to beat the drum on third-party vendor authority, which I think this could be the straw that breaks the camel's back, if you will. No pun intended on camel. But we could see that. I've seen two different stories out where leaders in the industry are saying, no, they shouldn't have it. And someone came out yesterday and said maybe they should in light of things that are going on. And NCUA does postmortem reviews on things when things go bad. And there's clearly going to be lessons learned from what's going on in one particular credit union right now, which has dragged on far longer, I think, than I'm sure that they had wanted or their members had wanted. And I'm really surprised how limited the press has been nationally on that particular event. I am going to have a podcast coming up talking about how are we going to frame it on having good communication plans for when things go wrong, because going back to the theme of this, how important communication is with NCUA, it's even more important when you're members when things go wrong. John McKechnie, former PACA director, and I are going to get on to talk about that sometime here in the near future. Definitely challenges out there. Steve, any thoughts on that particular topic?
No, I think we covered it. It's not fun to talk about. Let's not talk about it.
If that's a wrap.
Yeah.
I love it. All right, guys, this was fun. I'm sure we missed a few. And when we chat tomorrow with another client or a pre-talk with the client or something, I'm sure we'll go, you know what, we should have brought up X. But this will be something maybe we'll have every quarter where we just say, what are the trends we're seeing in our conversations with.
Interesting on the cyber attack, as you look at the telco, I've seen another article. The average is 22 to 28 days to recover from one of these. And like another one that's not getting national attention, I don't know if there's any Lithia car dealers where you guys are at. Lithia is a big national chain. They had a cyber attack. It's over a month ago, and I know a person here in Billings. They're still doing everything by hand.
Are you kidding me? Wow.
Their whole service department by hand. You go buy a new car, it's all the dot person. They're filling it all out by hand. Their systems are still down, and that's over a month ago.
I guess that's why the NCUA board always frequently says I can't sleep at night because of what I'm hearing about cybersecurity and that car dealership problem, the ransomware we're talking about. Things seem to be ramping up, right? I think we'll be seeing more and more of this, which means NCUA will be talking more and more about it, and perhaps having you add some more things to your budget that you can't afford, but that you need to do. All right, guys, this has been fun. Any last thoughts?
Hey, no. I thought you were done already when I started talking about the 22-day.
I was done, but then we started talking about the 22-day average, and we forgot to weave in that reference to the car implosion, that car software. It's crazy stuff. All right, guys, this has been fun. Listeners, Steve, Todd, thank you. Listeners, I want to thank you for listening as always. I hope you'll listen again soon. Mark Treichel signing off with flying colors.
Thank you for joining us on this episode of With Flying Colors. Subscribe on your favorite podcast app to hear future episodes where subject matter experts of all varieties and provide tips on how to achieve success with NCUA. If you would like to learn more about how we assist credit unions, check out our services at marktreichel.com.